The most expensive central bank mistake is not usually moving too late. It is pretending the old job still fits the new problem. That is the real story here. Most people still imagine the Federal Reserve as if it were a very large thermostat, inflation too high, raise rates, growth too weak, cut rates, markets tense, speak softly, labor softens, ease a little. The whole institution gets reduced to one lever and one number, as if the economy were still simple enough to be managed through a clean choice between hotter and colder money. That was never fully true. And it is becoming much less true now because the Fed is no longer just being asked to balance inflation and employment. It is being dragged into a much uglier triangle. Protect the economy, protect the dollar, and protect a debt structure whose interest bill is becoming too large to ignore. That is the actual problem beneath the headlines. Not just that rates were held steady. Not just that some members wanted hikes while others wanted cuts. Not just that Powell is leaving the chair but not fully leaving the building. The deeper story is that the institution is being pulled toward a job it was never supposed to admit it had. Keep the whole credit machine from tearing itself apart. Once you see that, everything else starts making more sense. A pause is not neutral. A divided vote is not just drama. A new chairman is not a reset button. And the public fixation on one meeting, one speech, one name starts to look like what it really is. Theater placed on top of a structural crisis. Your source document tells the story in the usual modern way. There is a no-cut, no-hike decision. There is the most divisive internal vote in decades. There is Powell stepping down as chairman while remaining in place because of a Justice Department investigation. There is Kevin Warsh waiting in the wings with ideas about cutting rates while shrinking the balance sheet. Fine. Those are the visible plot points. But the most valuable line underneath all of it is much simpler. The Fed is no longer just deciding what is good for inflation or jobs. It is being forced to consider what happens if the debt service burden itself becomes a monetary problem. Fay Filesite, Fay Turn 41 File 0 Fay. That is the real break. For years, the public was taught the clean dual mandate version of the story, price stability and employment, inflation and jobs. That was the neat classroom model. But what happens when national debt grows so large that the annual interest cost becomes one of the largest claims on public revenue? At that point, rates are no longer simply a macroeconomic tool. They become a debt management variable, whether the central bank likes it or not. That is when the old story starts cracking. If rates stay high, the economy feels pain, the housing market strains, refinancing becomes uglier, businesses slow, labor demand softens, and the Treasury keeps paying more to service old promises. If rates fall too early, inflation can come roaring back, the dollar can weaken, assets can reinflate too quickly, and the bond market can start asking whether anyone is still serious about preserving purchasing power. If the Fed pauses, as it just did, it is not because the world is calm. It is because every path injures something important that is not stability, that is cross-pressure. And cross-pressure is exactly what defines dangerous policy periods. I want you to imagine a bridge carrying three armies, each claiming the bridge belongs to them. One army wants lower rates because the economy is tiring and political pressure for relief keeps growing. Another army wants higher rates because inflation is not dead. Oil has moved up, and the dollar cannot be defended forever with soft language alone. The third army wants debt service not to spiral because once interest on the national debt starts swallowing too much of the fiscal machine, the entire political system begins looking for easier money. Whether it admits it or not, the bridge does not get to choose one owner. It takes stress from all three. That bridge is the Fed. And the stress is now too visible to ignore. That is why this moment matters more than most Fed just did something thumbnails do. The rates decision itself is almost the least interesting part. The more important thing is that the institution is starting to reveal that the old clean logic no longer fits the world beneath it. This becomes obvious the moment you move from the policy rate to the debt arithmetic. The United States has accumulated so much debt that the annual interest bill is no longer a footnote. It is becoming one of the dominant lines in the fiscal picture. A government can pretend for a long time that debt is just a stock number. But once the flow cost of the debt begins demanding $1 trillion a year or more in interest, you no longer have a philosophical issue. You have a budgetary stress point. And budgetary stress points eventually become monetary stress points because democracies hate clean pain. They hate obvious austerity. They hate large tax increases that voters can understand in one sentence. They hate admitting that yesterday's deficits are today's handcuffs. So pressure migrates to the place where pain can be blurred. Money, that is why debt problems so often become currency problems rather than honest political problems. Not always through collapse. Often through drift. The country keeps spending. The Treasury keeps issuing. The central bank keeps trying to manage conditions. The public keeps being told everything is under control. And slowly the line between macro-management and debt accommodation gets harder to see. This is what your source calls the net interest trigger. I care less about the phrase than the insight inside it. Once interest on the debt becomes too large to remain background noise, monetary policy is no longer only about CPI and payrolls. It becomes inseparable from the government's ability to fund itself without blowing out yields, breaking growth, or diluting the currency too aggressively. Fay-Felicite Fay-Turn 41 File 0 Fay. That is a much more dangerous game because now the Treasury market matters even more than the public realizes. The public still thinks the Fed sets all rates, that is kindergarten finance. The Fed sets the front end, the market prices the rest of the skeleton. And if private demand for treasuries weakens while issuance stays enormous, and the central bank is trying to reduce its own balance sheet, then longer-term yields can stay elevated or even rise regardless of what the Fed wants at the short end. That is where Kevin Warsh's vision, as presented in the source, becomes so important. He wants to cut rates while shrinking the balance sheet. On paper, that sounds beautiful. Stimulate the economy at the front door, remove money from the system at the back door, support growth without reigniting inflation. Elegant. And elegance is exactly what makes policy ideas dangerous, because the plumbing always asks a crueler question: who buys? If the Fed stops being a large marginal holder of treasuries and the government keeps issuing heavily, private buyers must absorb more of the paper. If they do not, yields go up until they will. And if Treasury yields go up, mortgage rates, corporate borrowing rates, refinancing costs, and all sorts of consumer borrowing rates feel it too. This is why I always laugh a little when people talk about just cutting rates as if the system were a faucet. You can lower the policy rate and still fail to produce easy conditions. If the bond market decides your debt supply, inflation risk, and institutional credibility deserve a different answer. That is the contradiction at the center of the story. The Fed can announce, the market can overrule. Not completely, not all at once, but often enough to matter. That is why Treasury yields are not bond trivia. They are the master pricing rail underneath almost everything. And this is exactly why the Source S mortgage example matters more than it first appears. A bank does not lend in moral language. It lends in relative return language. If treasuries are paying more, every other rate in the economy has to move around that structure. So a central bank trying to help growth by nudging lower at the front end can still discover that the rates households care most about do not cooperate. Fay-Felicite Fay-Turn 41 File 0 Fay. That is how easy narratives die. And when easy narratives die, most investors become emotional. I prefer to become mechanical. But before I tell you why, we need to talk about inflation. Inflation is the one variable that makes the whole machine crueler. The public hears inflation and thinks groceries, rent, gasoline, maybe insurance if they are especially annoyed that week. Fine. That is the lived version. The policy version is nastier. Inflation is what robs the Fed of the simple rescue. Inflation is what makes every cut politically suspect. Inflation is what keeps oil from being just a commodity headline and turns it into a central bank problem. Inflation is what tells the bond market that maybe the state will choose softer money over harder truth if things get tight enough. That is why oil matters so much right now. Not because oil is everything, because oil infects everything. Higher oil prices are not merely bad for drivers. They move through freight, fertilizers, food distribution, airline pricing, plastics, industrial inputs, and the psychology of households who were already tired. That is why an oil shock is such a cruel gift to a debt. Heavy system, it pushes inflation higher while also threatening growth and confidence. A central bank facing that setup does not get to choose a clean victory. It gets to choose who absorbs the pain first. This is also why the internal split at the Fed matters much more than usual. A divisive vote is not just institutional gossip. It is the visible sign that the old consensus map no longer resolves the terrain. If some members want hikes to defend inflation credibility, while others want cuts to support growth, then the institution is telling you in public that the old one-variable story no longer fits the system underneath it that matters. It means every press conference, every pause, every bit of forward guidance is now sitting on top of a more unstable base, which brings us to Powell. The public always turns central banking into a personality contest because personalities are easier to digest than structural stress. Powell the resistor, Trump the pressure machine, Warsh the coming cutter, the DOJ investigation, the board politics, fine, all real, all interesting. But one of the most expensive habits in finance is mistaking personalities for the machine. The machine is still debt, inflation, Treasury, supply, private demand for government paper, housing sensitivity, labor fragility, oil pressure, and the constant political desire for easier money than the inflation picture honestly allows. That is why a new chairman is not a magic reset. A new chairman is a new style of managing the same impossible triangle that can matter a lot. It cannot erase the triangle. This is where I become extremely interested in the source AS reference to redefining inflation and reducing press conferences or forward guidance, because that is not just a stylistic tweak. It is a signal the public already feels, often correctly, that reported inflation and lived inflation are not the same thing. Housing methodology, substitutions, basket weightings, all the usual mechanics create a number that may be statistically defensible and emotionally absurd at the same time. The moment a new regime starts talking about redefining inflation, the investor should hear something much deeper than technical update. He should hear a struggle over what reality is allowed to count. That is a very big deal, because if the debt burden is large enough and growth is fragile enough, the temptation to soften the optics becomes stronger. If you cannot reduce the pain cleanly, you can at least change how the pain is measured and described. That is one of the oldest moves in the political financial playbook. Rename pressure, stretch time, blur comparisons, use professional language to make deterioration feel managed. That is why I distrust every phrase that sounds too smooth. Redefining inflation is not neutral. It is a power move. It says the machine may not change what you feel, but it may change what it calls what you feel. That is why investors have to become more literate than the official number. I do not say that theatrically. I say it because once debt service, inflation, and growth start colliding, the statistical language itself becomes more politically valuable. This is also where your paycheck enters the story, and your paycheck is the part that matters most. The source is right to keep dragging the conversation back to wallets and wages, because that is where macro stops being a television discussion and becomes a life discussion. Inflation is not only a market story, it is wage erosion, it is savings erosion, it is a slow attack on people who did the respectable thing and still find that their purchasing power did not keep pace with the official assurances. That is why the average person feels angry. They are being told inflation is better than it was, but they are not being paid like life got easier. That split matters more than any one policy decision, because once households live inside that split for long enough, they stop trusting the language of official success. And a system that loses public trust while maintaining asset inflation becomes much more politically unstable. That is why the next Fed era is so important, not because the next chair will discover some secret, Because the institution is moving into a phase where ordinary cyclical management is no longer enough. It will increasingly be judged on whether it can hold together a debt. Heavy order without breaking the currency, the labor market, or the Treasury market first. That is a much harder job. And it leads to a very different kind of investing. Not prediction worship, not trying to guess every meeting, not pretending you confront, run every press conference better than the bond market. It leads to process. It leads to asking what kind of world you are actually investing in. Am I in a world where rates can stay tighter for longer than households want? Yes. Am I in a world where inflation can stay more stubborn than reported comfort would suggest? Yes. Am I in a world where debt service has become too large to remain a clean background issue? Absolutely. Am I in a world where the measured economy and the lived economy have drifted apart? Very clearly. Am I in a world where the institution managing all of this is under more visible strain than before? Yes, again, that tells me enough. It tells me to respect real assets. It tells me to care about pricing power in businesses. It tells me not to treat dead cash as a long-term comfort blanket. It tells me to watch Treasury yields more closely than the average investor does. It tells me the next policy era will likely be less about neat rate cycles and more about improvising inside constraints that the public still does not fully understand. And it tells me not to expect a heroic institution to hand the value of my paycheck back to me neatly. That is a very important realization, because once you accept it, you stop asking the Fed to solve everything for you. You start designing your own defenses: less stupid debt, more productive assets, more suspicion of nominal stability that is losing real value underneath, more attention to what is actually being repriced in your life. That is the hidden curriculum here. The source wants people to watch May 15, the chair transition, the no-cut decision, the divided vote, the Warsh plan, the balance sheet debate. Fine, watch all of it, but do not stop at the theater. The real story is not what day the title changes on the Fed door. The real story is what kind of monetary regime is being born. When inflation, debt service, Treasury demand, oil pressure, and weak real household purchasing power all stop politely taking turns and start colliding in the same room. That is the story, not the Fed just did something no one expected. The deeper line is this: the Fed is being pulled toward a job it was never supposed to admit it had: manage inflation, manage growth, and quietly help keep the debt machine fundable enough that the whole order does not shake itself apart. That is too much for any clean institution, which means the next phase will likely contain more contradiction, more narrative conflict, more public confusion, and more pressure on the real value of every dollar ordinary people work for. That is not fear-mongering. That is structure. And structure matters more than drama, because once you understand the structure, the headlines lose some of their power over you. The chairman changes. The press conference style changes. The inflation definitions may shift. The vote splits. The Treasury market may disagree with the policy rate. The paycheck may keep losing real ground even while the official number says inflation is under control. And underneath all of it, the same question will remain: who absorbs the burden when a debt-heavy system can no longer satisfy currency discipline, growth softness, and fiscal excess all at once? The public answer will be speeches. The real answer is usually the holder of cash, the earner of wages, and the person who believed polite central bank language longer than he should have. I would rather not be that person. That is why I watch the machine, not the show. And right now the machine is telling us something very clear. The next Fed era will not be defined by whether one man cuts or hikes first. It will be defined by which part of the system is forced to bear the burden when one number is no longer enough.